are live. I think I see us. Is this working? Leroy, are you there?
Super excited to be here. Thanks for having me on.
Yeah. So for everyone, this week's Veterans Voice topic, I'm really excited about it because I definitely can use a lot of education on how this is going to affect veterans in general. And I know, not everyone probably is reading the published guidelines coming out, or even to interpret them and kind of understand the big why behind them. How does that affect the short term? And what is the short term impact? What is the long term impact? So with all further ado, I have Leroy Romero. Leroy, can you intro yourself for those in the group that aren't familiar with you?
Yeah, absolutely. I'm super excited, not only to just hang out with you here since we've hung out before, and with what you do for the VA community. I think it's just amazing. So thank you very much for doing that and being a huge veteran advocate. So my name is Leroy Romero. I'm a licensed loan originator. I do have a real estate license as well. So what that really means is that I think it helps bridge the gap between a lender's conversation and the agent conversation, and the communication on how to better serve the veteran community. So I'm licensed in 10 different states. I am a mortgage broker, not a mortgage banker. So there's a little bit of a difference in there between a retail and a broker shop. So maybe we'll hit a little bit on that. I represent a couple different educational units as far as being a CE certified instructor for military mortgage boot camp. And then I'm also part of a big movement right now, which is Vetted VA. And what that really does is it allows veterans, lenders, agents, the consumer, kind of a safe place to talk about VA loans and the questions that might come up without being heavily solicited, within the group. So that's why I'm here.
Awesome. Well, thank you. And, there had been a couple of posts where maybe some people felt like a lot of the caution and warnings that we were alluding to were maybe kind of like baiting or, and it was something that I really, really wanted to kind of squash as well as bring to light, because I'm so big on education. I service a lot of buyers in my business, and probably the one thing that I do is pull the reins back, right? I'm not one to just let people go by their heartstrings without thinking through everything, from a very analytical and strategic perspective. So with that in mind, being armed with knowledge and being armed with the changes, which, there hasn't been any significant rewrites to the VA guidelines in a long time. So I really want to make sure that we are providing, accurate information, accurate education, and really how we can best support our veterans. So Leroy, can you kind of line item go over some of the changes that have happened? Like what is the date? What is the suspense date on this?
So we're looking at January 2020, right? We'll start off with that. One of the things that I really want to comment on this, because it made me kind of switch my way of thinking about a year ago when you and I had a conversation in Bellingham about how you really walk through the veteran when they're purchasing a multi-level home versus a single-family home, and when they're stationed in Alaska, and how does that work for long-term. And so it really kind of took me back a little bit and thought, man, how much more education go around the VA community and the agent community, because I don't know a lot of people do that, right? So sometimes we get in the sell mode. We have to remember, though, where are they going to be at 3 or 4 or even maybe a year if something happens when they have to go PCS again. And so taking that into consideration, having that full buyer's presentation, with them, and talk about their goals for long-term ownership with using the VA loan, I think that's huge. And some of those changes that are coming up, especially with the removal of the cap, which is just amazing, right? So we'll start with that.
People more entitlement power, basically.
Yeah, and it's really been reserved to whatever your county loan limit is. So for you in Alaska, I would imagine it's pretty high.
726,900.
Yeah, so for us in Idaho, so currently I'm in Idaho, I'm based out of Phoenix as well. So for us, it's 484,350. So as that market comes up, when we're thinking multi-family units, we're really kind of up against that level to where home ownership becomes kind of a tight squeeze, or if we're looking to, someone with a larger family, or if they're looking to use their VA loan to invest, those types of things. So the removal of the cap, I think, in my opinion, is just phenomenal because it does allow, the veteran to still act as an entrepreneur within that, within the loan. So how it works is
because a lot of times when veterans are moving from duty station to duty station, and it works going this way, for example, if they own a home, in Virginia, because they were first stationed there, and then their cap there's like 300 and something thousand in certain areas, right? And so then they'll come over to Alaska, and now they've got $726,000 to play with, so they can still have another, enough room on their benefits. So for subsequent purchases, then are we saying that they can buy multiple? Because before there was a maximum of 4, loans that could be written on one entitlement. So now is there no max on the amount of properties that they can acquire with a VA loan? Are they able to continue to reuse it?
I'll definitely do some more research on that one, but the continual use is constant. So the removal of the cap, and they just came out with an updated circular saying, hey, look, there was a lot of assumption when it came out. You said, hey, is there a lot of baiting around this? When it came out, there was a lot of speculation still. And so the VA just came out with an updated circular and said, hey, here's where we're starting at. And then of course you're going to have your investors, because you have to remember that the VA says one thing, but the investors,
the banks are going to say something else.
Yeah, they're going to say something else. And that's what's key about, making sure when you're paired up with an agent that either understands it or is thriving to be educated in it, because everybody starts with one transaction, right? So
while we're on this exact topic, what I'll say is for the agents that are watching, a lot of times you'll hear something, especially if you don't do a lot of VA deals in your area, you'll hear something back from a lender that'll say, oh, the veteran is not qualified because of X, Y, and Z, but that in fact is not a VA guideline. That is an overlay that the bank, that particular institution is creating based on their absorption of risk for a veteran, right? And so sometimes when people will disqualify veterans for any particular reason, it could be specific to the lending institution. And I think that's what Leroy is saying. And sometimes if you don't do a lot of VA loans or work with, brokers that have access to multiple, investors, lenders that are going to actually fund the loan, then it's kind of hard to know which is part of the lender guidelines and which is part of the actual VA guidelines. So being able to differentiate the two is really essential when you're really trying to help your veterans so that you can find the best options for them when it comes to their financing. And so you're saying, number one, the removal of the cap, right? That's right. What's taking place, the removal of the cap. What else do we got?
Well, in the removal of the cap, there was some speculation, and we were just talking about this in another group, is that really it removed it. We were thinking, okay, hey, it's at $1 million. Well, no, it's the removal of the cap, and now there's speculation, well, hey, the cap's going to be at 1.5 million. That's what the lenders are kind of talking about, right, at a zero down. So that's kind of the speculation out there. As we get closer, what's that?
Their absorption of risk, Just like there's no published guideline for a credit score or debt to income ratio, but like you can, a crazy day, you can get about to 72% without it exploding on you, right? Or, without other findings, or 580, I've seen lenders as low as 560 for a season there that were entertaining VA loans, but there is no published guideline also, right? So now there's no published loan limit, but the investors are going to say, like, to what threshold will they do 100% financing if they can't recapture the asset without skin in the game, right?
Right. And, I think that's what they look at is, from a financials, standpoint, we're in that shift, right? The market shift, there's talk of a recession, those types of things. And so, there's got to be some kind of risk, but it's going to be a different type of recession. It's not going to be so much the housing, because there's been all of those overlays that have kept the housing market really stable, and as well as rates being so low. So as we shift into that next recession piece, that's going to be more like job loss, those types of things versus maybe a hit to the housing market. So the housing market,
I would almost look at some of that with the shifting. I feel like we've been in a shift, but I think now, we're not going to see such a national economic shift like we saw in 2008, that was hit on a different level.
Oh,
But
yeah.
I think what we're seeing is a lot of, when we look at those macro indicators in the economy, that we have seen shifts. Our shifts don't look like steep declines in property. Our shift looks like a shift in absorption rate, right? So our homes sit on the market longer, but then we kind of start to pick right back up. So we are actually recovering. Alaska is actually in phase 4. We're going back up the hill. So we've been in a shift for probably the last 2.5 years. But like in different markets, it's going to look differently, right? Depending on what's the source of economy in that particular market and how that micro economy is evolving, changing, growing, or receding based on other factors. So, it's crazy to see kind of the how different the markets are actually shifting. And that's what I was actually talking to Chris Griffin last time, is Lab Coat Agents is such an amazing group to be able to tap into people and say, hey, my market is declining here, but where is another place to invest, right? Or because across the country, we have agents everywhere. And this is such a valuable resource to be able to connect with each other and like get a gauge and temperature on every micro, economy across the country. So that's super cool. So you were saying that there's speculation on, exactly how much will they do 100% financing for. For me, my brain, because I always go with investments, right? I want to know how many properties can my veterans acquire, and because I'm usually racking and stacking multiple investment loans. So we definitely want to circle back on that. Is obviously every lending institution and the VA guideline will have a guideline on having reserves or not having reserves based on their debt to income ratio, and then also how many properties can we stack on this no ceiling thing. Like that's a big giant question in my brain too. So
and I think that's probably one of those ones that they'll define, lender specific. And again, it's going to go back to the education, like you said, is the more that we know. That's the nice thing about this group, is that information can come to the source and it's vetted through here. Like, hey, it's not just bogus information. You're dealing with some of the top experts. There's so many amazing people that are in this group that share that information freely, right? So it allows you to be educated within the group without having to go out and spend a ton of money on, hey, do I have like the MRP, or do I have this certificate, or this lender is offering this, do I get this, those things. The biggest thing is to strive for education. And I'll get that information for the multiple properties and we'll put it in here.
That really applies to me personally, because I have a fourplex that cost me about $470,000 here, and since our ceiling is 726, one of the things that I have been butting up against as I go back for another residential asset is and using an owner occupied option and kind of looking at that opportunity. When I look at qualifying, based on justifying living in the property, that's one standard. But then when I was like looking at, well, what can I fit within $350,000 or $300,000, and then, or how much down do I need to borrow, if I'm going to go with the jumbo product and, borrow excess. So for me, looking at no cap, I'm like, which one do I want? Because now I don't have to worry about my down payment. I just have to worry about my reserves. And so, it kind of looks like, it definitely opens a lot of doors for me as far as an investment vehicle. So without the cap being published. So, so that's huge. And it really gives people, veterans, the ability to have more passive income streams. At the end of the day, the reason why I'm so passionate about veteran and real estate investments is to give them not only equity position in single family homes, but the passive income streams to be able to support their families should they encounter hardships down the line where the military is not able to support them. And what better fallback plan than to have than real estate assets. So Leroy, what else are we looking at in the guidelines for big changes that we would care about?
We've got a couple. I'm going to hit the one thing that is definitely changing, and that's going to be the funding fees. And I'll put the circular in the links in the comments below, so everybody has access to that.
From the veterans website, so it's not like hearsay or interpretation, right? Mm-hmm.
You got it. Yeah, right from the VA website. So there's going to be a small bump, and I know that everybody was kind of freaking out about it, or getting kind of crazy about it, like, hey, we pay too much. But you got to remember that we fund our own loans. Like veterans have always, not only do we have a community now that really looks out for veterans, we've got a lot of veteran advocacy out there, that's happening. But veteran to veteran, like we're always looking out for each other, right? So it's one of those things when you look at the increase in that, the ability to go 100% financing and subsequent use to be able to use that benefit over and over, we have to pay a fee. If you're not disabled.
There's no other products like it. And I'll tell you something, like whenever I explain to my veterans, like you have your civilian counterpart that has to pay 3.5% and then lifelong PMI for the life of the loan. Like if you're going to charge me $300 a month, the veteran to live in the same $2,000 house, the civilian counterpart not only has to put down 10 plus grand, but also is going to pay an extra $300 on that mortgage payment because of PMI. So even if you're going to bump me, like another $1,500 at the closing table, but I don't have to pay $350 a month for the life of the loan.
I'm in.
You're complaining. Like you're still complaining, right? So it's all about, as realtors, when you look at veterans coming back with maybe these how do we have objection handlers for that? Like, and it's really to talk around that and to shift their perspective so that they understand still the value of their benefit.
Yeah, absolutely. Some huge changes. We can shift into huge changes. And this deals with more of, say, clients that you've been working with, right? So we know that the interest rates, big interest rate talks, everything's dropping, which historically it shouldn't, but the way that it's going right now has been phenomenal. So when we talk about interest rates, a lot of things just change with the VA. And there's a couple things that I really like about it, and that's that rule of the 210-day refinance. So the reason why that was created, that there was a lot of things going on with the Ginnie Mae bonds and how that was working and when those were being purchased. And so you had some lenders out there that were, I like to call it equity stripping, or churning is the term for it, where they would, sell them at a higher rate and then come back and refinance them. And that would happen from month to month to month. And so it puts these veterans in a bad position in their equity, which is what they're supposed to be building over, their lifetime. And so when these rates dropped, there were some rules that were just put into place, which was awesome that the VA stepped in and said, hey, look, we've got to now we have this 210-day rule. And they weren't very specific in it at first when they rolled out the Blue Water Bill and put that into place. And so now they came back out and said, hey, look, that 210 days for you to be able to refinance, how that works, it's going to be off of the first payment due date, not when you made your first payment.
Not when you close. It's from actually when you make your payment, which sometimes is 60 days out from closing.
Yeah, it could be the way that it's structured. So you just have to have 6 payments. So once you've made those 6 payments and you're at 210 days, so if you really back it down, you can lock as a lender, as a broker, I have options where, a 30-day lock is the same as a 60-day lock. So I can really back down that 210 days. And the reason why I think that that's so important for the agent community to understand is that it's always been, you've got your lead generation, obviously you do, but the biggest source of your clients are really your sphere of influence. And so when you are soliciting or being in a referral partnership with your book of business per se, those clients of yours, they're getting hit from day one when they close on that property from lenders left and right to refinance that loan, no matter where it was at or what it was doing. And so as an agent, if I put my agent hat on, I'm like, okay, so I need to stay in front of my book of business because they're getting all these letters, Vanessa, and they're going, what is this 2%?
Probably a good time.
Yeah. And so when you're educated as an agent, it's saying, look, I know you just got this paper at 2.75, but did you see the fine print where it says 2 points added? Does that make sense?
So like, Lord Jesus, I have someone who bought a home with us, and I do guarantee my homes. I will sell a home for free if my client buys a house that ends up underwater for him. Mostly because I especially if they take my guidance. Sometimes people buy whatever they want, and then I don't guarantee them that. But this client of mine, he want to sell kind of early, and he actually had a really good deal on the house. So probably bought it about $30,000 under what it could be worth in an upswing, and so he was really ready to move, and because he had refied, because he got some crazy luring 2.75 offer, And when he asked me to sell his house and he told me he refied, and I looked at it and it even was an adjustable rate. And I'm like, wait a minute. And they added like $12,000 to his principal balance. And on top of that, it only changed his payment like $35. And I was like, they lured you with the 2.75 and you're still paying within $100 of the same payment you had originally at a fixed rate of 3.6 or something. Oh God, Lord Jesus. And so if we are not as agents caring about like not being the source of education for our clients, they will be baited by all sorts of weird scams. And now, like, even when he just talks to a property manager, he's like, Vanessa, can you read these documents? Are they scamming? You know, but he's calling me because now, you know, he trusts me, and it even hurts me that it came out of me saying like, what did you buy? You know? So yeah. Exactly.
I love that point, because when I look at that, Vanessa, what happens is your book of business, like, that's your family, right? So you've got this clientele. They're Vanessa fans. Those are your raising, just the people that are all about you. So what happens is when a lender comes in, right, and I feel like mortgage guys or mortgage people, I should say, you know, we're starting to understand the lead generation process. But these bigger companies, right, the QLs or the LDs that are out there that are hammering.
What's an LD?
Two of the largest online lenders, right? So say, you know, like okay, so when they have that big,
initial QL and LD, got it.
Yes, you got it. So those guys, well, what do they have on the side? Well, they have real estate companies on the side. So let's just say I'm known as a phone jockey, right? A headset jockey. I'm on the phone, and I love being on the phone, you know that. And so when I'm on the phone and I'm calling and I'm going to refinance your client, right? And I just say, hey, look, you know, Jim, I'm going to refinance you. I'm going to get you into this great loan. We got you at 3%. So, hey, if you ever have any other real estate needs, just let me know, because I've got a preferred real estate agent in your area. And then boom, they become part of these larger companies' funnel. So now they're getting that piece, and you have possibly lost your clientele, because now it's coming to the lender's funnel where they have a real estate company on the side, and now they get that referral over to their preferred agent, right? Who might not know or be like the local resource. It's just the person that happened to be next on their list where they can grab the referral fee. Hey, if you sell your house with me, we're going to knock off some of our closing costs, which are probably inflated anyways. We're going to knock off that closing cost for you. And if you buy with me, then we're going to give you a discount on closing costs on the next home. However, we'll want to patch you up with one of our preferred agents. So what the agent has to understand is that these companies, and if you're not staying in front of your clients and educating them on the people that you use as an agent that you trust, that these online lenders, they're going to come in and they're going to grab your book of business, and they're going to start to filter them over to their funnel for their agents.
Their referred agents, right? Mm-hmm. Yeah, and it's unfortunate that, you know, that does tend to develop that way, and that's why it's our responsibility to keep our relationships genuine and sincere, and always and with our fiduciary to our clients and their interests. And okay, so we've got the loan limit, we've got an increased VA funding fee. What else are we looking at?
Yep, we've got that removal of the 210 days right there.
So now they can refi sooner.
So they're still on the 210 days, but now it goes off of the payment date versus the actual payment made. So I used to have to verify, right? Hey, when did Vanessa make her payment? Oh, she made it on the 28th, but her payment was due on the 1st. So I have to go off the 28th date. It basically shrinks that gap, so the veteran's now able to kind of execute on what the market's doing, which is nice. So,
okay, so the 210-day thing is adjusted. Okay.
Correct. And then you've got a lot of fees that before you couldn't really wrap into the loan. So places like high tax areas or have high tax credits and things like that, as far as, like, say, Florida is a good example, right? Super high taxes. And like Illinois is another one, right? So some of these veterans in these areas that have high taxes, well, your recapture time frame for the VA IRRRL used to have a certain amount. It's always been 36 months for a tangible benefit. You had to hit, you know, one or the other, but now you have to, no matter what, hit that 36.
So now my agent brain went, I don't know what you're saying. Okay. So the 36 months of
right? So you
So
have to.
this is when I'm like, okay, lenders, come back. What did you say?
So you have to be able to recapture your costs within 36 months. So
Wait,
if you're,
recapture your cost. Whose cost?
so the veteran's cost. So let's just say $3,000 is your total cost of your VA loan, right? To refinance your VA loan. That's
Okay,
the
got
total
it.
cost.
Okay, their fee. Mm-hmm.
The fee. Total cost. And the funding fee used to be in that. Now it's not. It's removed. So it's not accounted.
And
Escrows
the
are
VA
no longer
funding
counted.
goes straight to the VA, not to the lender.
Correct. Yeah. You bet. And it's
So
a half a
you're saying
percent.
the lender has to recapture it within 36 months? Is that what you're
The
saying?
consumer does. So your break-even point for your refi is 36 months. So that's an
Got it.
way to just compare, like, does it make sense? So your guy, right, saves $100, tax on $12,000 in fees. It'll take 120 months because he saved $100 a month.
Got it. What I was just explaining with my guy Phil. Okay. Yeah.
Yep. So now it's 36 months, 3 years, right? Well, now you think from a veteran standpoint, like your cost, you've got the equity position rising in the market, right? You've got your principal reduction, and then you have your 36 months in your cut. Right. So it protects that veteran from being overcharged again.
So you're saying exactly what happened to my client Phil, who like refinanced to save like $70 a month and was charged like a ridiculous amount of money.
Yep. It's going to really protect them.
Wow, that is huge, because that was my big, I try to explain that to clients, like the return on their investment. Is the property worth the refi? When will they recapture? What do they intend to sell? Like all of that stuff. And a lot of times that math is a little confusing because consumers don't deal with that on an everyday basis,
Totally.
So that is really good to know. What was it prior to this change?
There were some stipulations as far as cost. It was really the Wild West when you think about the turning. There's certain other companies. I use a lot of initials so people can do their research. Like ND is another one where they're overcharging these veterans and they're not able to recapture their cost, or equity stripping, however you want to put it, churning the loans. So that's going to really
either put it on their principal balance, or they're packaging it somewhere in the refi, and the consumer doesn't understand where the money is going.
Yeah, and so that's another key thing with that being, and then there's a huge one that just changed. I don't know, in all transparency, I don't know how I feel about this as a veteran. I think it's a good move, but I'm not sure. But as a veteran, you've always been able to do 100% cash out, right? So cash out of your property. So I've been able to use my property as a vehicle to either do investments, but it's my property. It's my entitlement. I say entitlement, like that's the only place I think entitlement is okay, right?
You're like, I serve for my VA loan, thank you. Yeah.
So, and and veterans have to know, even veterans or agents in here, is like, no matter the time a veteran served, if they sign the line to die, like that's an entitlement.
They were willing. Yeah.
I mean, it's just amazing, right? So, it's a volunteer versus voluntold. Like, we're not that generation of the Vietnam era. Like, it's a different world. And so those people that are enlisting and doing those things, like, holy cow, that's amazing. They're volunteering to go out and die for us, right? They're willing to do it, put their line, sign the line and go for it. So back to the 90% rule, how that changes on September 15th, basically what was happening again. People are turning.
So this was the 30-day thing that you guys are talking about, was not being able to do the 100% cash out, right? So what is that? Explain that to me. Yeah.
So as a veteran, let's just say I have a property. So I have a property, it's $300,000. I owe $150 on it. I could go to $300,000, right, and pull that cash out and be okay. Obviously, there's qualifying standards and those things. Now, before, I could go 100%. I could pull all that money out and use it for me as a veteran, whatever my means were for it, right? So now, I'm capped at the 90%. So I have mixed emotions about this. One is that, hey, thanks for protecting me, but I'm good. I like my 100%, but I do like it in the form of the protection for the veteran against lenders that aren't having those conversations in depth where it makes sense to do a cash out refinance. So in this position, being stuck, we're going to be capped at 90%. So 90% loan to value, which is still more than conventional at 80%. And FHA just went from 85% loan to value, right? So you could take out loan to value 85%, so 15 basically in equity. On FHA, 20% equity, you're capped at 80%. Well, VA was at 100. Now we're going to come back and go to 90%. And that changes is across the board. You're going to see with most investors, there might be some lenders that still allow 100% financing. However, I would be very, very cautious in a dire situation. And that's why it's important to stay in front of your clients. Is at 100%, does it really make sense financially, right? We've seen, and we've actually, I have a gal I'm helping right now, but there was a cost, they rolled in some costs, but when you're doing a subsequent use for a cash out, giving you $10,000 when you have a subsequent use for a cash out VA, which is 3.3%, charging you $9,000 in fees to get $10,000 on a $300,000 home loan. That doesn't make sense.
It doesn't add up. It doesn't add up. Yeah. And, a lot of times, as a realtor, the reason why I care about knowing what my client's equity position is, as I am, like, aside from their resale, right? So obviously if they intend to resell the property, veterans are constantly moving. So if they're active duty, they're probably going to be looking at offloading the asset if they did not intend to hold it as an investment property. But what I look at and what I educate my sellers on is, this idealistic, idea of, growing old with your rocking chair and paying off your mortgage is not the wealthy's vehicle of investing. And so what I teach people that are really looking at, in the short term, on a short run, really acquiring a lot of real estate assets, which, by the way, as I help my buyers kind of acquire that portfolio, agents, when I'm looking at their equity position and how much they can borrow, if they need reserves, if they need the down payment for their next asset, if my clients already have a fourplex and a duplex and now they want that sixplex, and we're on this upward trend where they can bank on that natural appreciation value of the market, that plus their equity position. So now they've created that gap in their nest egg. Now my client is sitting on $80,000 to $100,000, can pull that cash out, can have their 20% down on a sixplex or an eightplex or another passive income vehicle. So when I show them how they can shift and capitalize on that margin, pull out the cash to reinvest it for another cash out and cash return vehicle, or go into that commercial residential real estate that's going to create more opportunity for them, it's gold. And that's how you teach, you empower veterans, and not just veterans, but this particularly on the VA loan issue, how you empower people how to scoop out their equity position, reinvest it in another asset.
Absolutely.
Yep. So cool. And I mean, and that is that I'm thinking about my fourplex right now, because I've been like, okay, I've got 100 grand on that thing right now, like, and now I'm like, oh shoot, September 15th, I don't think I'm gonna refi anymore.
We locked a couple today, so I think we'll be able to move them pretty quickly. But
at the same time, 90%, like, if I'm trying to like speak out every time, maybe I'm like, okay, leave for other people, that's fine. But okay, but that's good to know. What else do we got?
Yeah, I think those are the major ones that we covered. This essentially, and there's going to be more changes that come out. So I think the best thing about I think this is like the Tuesday update for veterans, which is just awesome that lab coats came in and say, hey, look, let's make a center point for education, which is what the foundation of that whole thing was about, right? So, I think that's killer, and we can always just post those things of what comes up in the group. Yeah. I think that to know that, hey, this is a great source to be able to grab that information and not be misled. So, and there's so many smart, very hardworking, educated agents and lenders out there that know this stuff 10 times better than I even do. So it's one of those things to keep pushing if you're new.
Foster conversation, right? To get information. And the biggest thing to mastermind on this stuff is to be able to think outside of the box. Maybe you haven't used the VA loan in this way. Maybe you haven't educated your clients in this way. Maybe as a realtor, you haven't seen the opportunity for your clients in all these different ways. And it's so important for us to mastermind around these topics so that we can be a better resource, a better educators, better, everything to be able to provide those opportunities for our clients. What would I say? What was I thinking about? So yeah, to recap, we've got the removal of the cap. We've got the removal of the 210 day or the adjustment to that 210 day. We have the increase in the VA funding fee. You're going to publish some of those or the whole book. And then lastly, we talked about going from 100% cash out refi to 90%. Oh, my last question to you, just so that agents can also understand the structure of a cash out refi. So this is not a home equity line of credit. This is them rewriting their VA loan. So the entire package of their loan will then change to this new loan. Like they just basically rebought their own house. So if they were in the market where they had a 3.25%, interest rate along, a long time ago, several years ago, now thankfully the market is in a good position, right? We're kind of like floating around that same area, but maybe when it was 4.5%, that probably wouldn't have been so great to make that adjustment, right? So
yeah, I think, and you really got to take that consideration as a professional, like as a veteran. And I think that at the closing table, or when you're doing like a 1 month or 6 month follow-up or a client appreciation party, whatever it is as an agent, you have to remind them as a veteran, like, hey, you're going to get these offers. If you run into life, because life happens, right? Changes all the damn time.
Right?
Yeah. And you need money, then it's a great resource for you. And if 4.5 makes sense for you, that's literally what we were at this time last year. So even higher in some areas. And so, when you look at that 4.5, if you're at 3.25, but you've got this credit card bill and massive medical situations or life,
right? Mm-hmm.
Yeah, then it does make sense. Say you're a disabled veteran, you don't have that funding fee, but yet you've got $27,000 of revolving debt that's hammering you every month. Well, it might make sense to use that as a vehicle. It's your vehicle, right? So now you're just going to be capped at that 90%. So, I think that's key to understand. It's a big part of it. And again, it's protecting your clients as an agent because that's really the source of the business when you think about it. You're the relationship piece, right? We're the analytical money guy, money gal that are, we're doing that part. But really when it comes down to it, the emotion is so tied into the home. Because it's not just another house, it's a home. It's where they move their family into. And so that relationship with the agent, nothing will ever replace that. And so it's important to understand the financial aspect of it too, for sure.
Yeah. Well, cool. Well, thanks, Leroy. I appreciate you jumping on here to share that from a lender perspective. Always appreciated. And I didn't see any questions that we've got right now, but I'm sure we'll kind of continue this conversation in the thread. By the way, if people wanted to refi at 100%, is it too late for them?
No, I don't. For us and our team, it's not. So we've got.
You have to close the loan before the 15th.
You do. You have to move. And so I think the one thing that makes a lot lenders get a lot of crap, right? So, they didn't close my loan on time. They took forever. But here's really what it comes down to is, do you have your docs together? Do you have what the lender needs to be able to execute the plan, right? It's just like every mission. You have enough intel to be able to make a decision, to be able to deliver on time. And if you don't, and you're part of that problem, as the veteran side of it and the consumer side is, as an agent, you become the advocate. Some agents that we're not licensed in Alaska yet, but with some of the agents that we work with, and I get an email like, Leroy, you tell me at one moment, like if they don't have a document in 24 hours to you, like I will call them, I will go get it myself. Like that's powerful. That's how you move into, those quicker in that partnership. Yeah, for sure. I think that's crucial. So, but yeah, is there a time? Yeah, absolutely. Our rate's phenomenal. You bet. Like without disclosing APR and that kind of stuff. But if you're not in the low threes, you should shop for sure. Yeah. Yeah.
That's awesome. Well, cool. Well, good to know. Thank you so much. And I will talk to you later, friend. Awesome. Well, I'm Vanessa Noble from Anchorage, Alaska. I'm happy to be a resource and help. And as always, Leroy, one of our awesome lender advocates in the group as well. Leroy, where are you licensed to lend?
So I'm with Next Mortgage. I'm a mortgage broker out there. Next is the fastest growing mortgage broker in the company right now. We'll be in all 50 states at some point. We're super excited. I think we're in like 14 now. I'm only in 10. So I'm licensed in Arizona, California, Texas, Tennessee, Georgia, Oregon, Washington, Idaho. I think I covered most of them. So Florida, Georgia, Colorado. So I'll put them in the link. So if you guys have questions, and here's the thing, like my phone number is 623-293-0044. Text me, message me. Even if I'm not doing your loan, I'm so well connected with so many other brokers that are, and so many people that are educated on the VA loan. You know, if you're a veteran or if you have a veteran client, that's kind of my duty, you know, to the veteran community is to make sure that you're not getting jacked. So, you know, that's the biggest thing that we look at. So full transparency. I might not be able to help you. However, I can connect you through vetted VA to be able to help out, you know, with somebody that I know that will be transparent and not overcharge.
Yep, absolutely. Cool.
Awesome.
All right, friend. Good night.
That's good.
See you. Bye.
Bye.